Hello and welcome everyone to the Capitalmind Podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capitalmind may maintain positions in the securities discussed in this podcast.
Hi everyone, and welcome to a new episode of the Capitalmind Podcast. In today's episode, we discuss if finance is the most, or perhaps one of the most forgiving industries out there. We look at examples of insurance, and in particular ULIPs, which often involved mis-selling or misleading customers, and the customers often came across as victims who would just forgive. 81 instruments, where the blame is a bit more equally shared. Asset management, including answering this key question, when should you fire your fund manager? Angel investing, where even though 90% of your investments may fail, there are still reasons to get very upset. So-called options trading or do this and become rich courses. And then finally the flip side, situations where customers have too much power and somewhat take advantage of it. So do listen in. Deepak, I think you've said this often, that finance is a very forgiving industry because sins of the past are easily forgotten and forgiven. Well, we've been working in this space for several years. I can't say I exactly agree with you, but I do understand where you're coming from. But I was hoping, could you elaborate on this a bit more? And why are you of the opinion that finance is this uniquely forgiving industry?
Hi, Shray. I think maybe because we work here is where we kind of see the egregious nature of a lot of things that happen in the finance industry, and like, how do they manage to get away with it or whatever and all that. And I think there are 3 or 4 things, so people think of it and say, you know what, this happened, but that was a different time. Maybe it's better this time. Maybe it's different this time. This time is different as, some of the 4 bad, worse, they aren't 4 worse words in the industry. And then within the industry itself, it's like if you're managing a fund and something goes wrong, they're like, oh, wait, that person's gone. There's a new person in and maybe this will change. Or if the same person is out there, we're actually saying, no, he's learned his lesson and he won't make that mistake again. Now, these are all maybe true in different concepts, but I think that nature of this exact concept which I described, which you wouldn't get away with in pretty much any industry. Like, for instance, you can't say an airline pilot was drunk, and the chances that person will be allowed to fly again in the near future is probably 0.
Or if at all.
Yeah. So you even have movies about pilots who are drunk and therefore can't fly airplanes, and then they fly, these drug trade wala planes.
God, I don't know what you've been watching, but I mean,
this is all Netflix. But you get this thing that that industry is no longer going to accept you, so you have to go out, which I think is not there in finance. It's almost like, listen, come in, we're okay, and maybe we should explain, of course, but it is a forgiving industry, maybe beyond how much you should forgive. And in some other cases, it is terribly, terribly unforgiving. For instance, you can't operate a PMS without an MBA degree, which is,
Well, luckily you have one.
Well, now I have one. So it seemed to have kicked that on. But at some level, it is harsh. And at some level, it is incredibly forgiving.
So let's actually start with an example that I remember when I was joining Capitalmind. I ended up reading a lot of your debates on this on Yahoo Finance as well, if I'm not mistaken, or Yahoo India or something.
Yahoo India.
And the folks arguing against you were doing so in very bad faith. And this was all about the world of ULIPs, those unit-linked insurance plans, if that's what they stand for. And where I've actually come to terms with this is meeting friends and family over the last many years working here, where people basically show up, say 1 or 2 years post having signed up for one of these, and are like, what on earth have I signed up for? There's this money going, which seems to be, there's very little I can do with it. I can't get it back. I had no idea what I signed up for. And we end up helping them unwinding, and it's not easy to unwind, and it takes a lot of time, and then helping them deploy their money elsewhere. They almost come with this sense of like, what on earth just happened? And I know you've had many battles on this, and one of the things you say is, this is still better than what came before it. So maybe even you're a bit of a defender of the gradual reform. But could you tell me more about maybe using ULIPs or insurance perhaps as an example. How is this an example of how people are particularly forgiving or kind to finance?
This is actually one of those cases where in the kingdom of the blind, the one-eyed man is king, right? So you overlook certain things because it's so much worse, so much better than the products that were existed before then. So, for instance, the initial idea of insurance was you have a long-term, insurance opportunity, but not so much insurance. Let's make it a savings opportunity. We'll only give you like 7 or 8% on your money, and you could pass on your wealth to your children without any taxes. At that time, there was inheritance tax. So insurance was used as a mechanism to pass on wealth. So you needed the wealth to be secured, but at the same time, you didn't care so much about returns because it was a mechanism to pass on wealth, right? So it was like crappy returns, 7, 8% at a time, when even government bonds would give you 11, 12%, and FDs would give you that much. But people were like, oh, you know what, this is post-tax, this is X, this is Y, and you got away with really lousy returns. Then came the ULIP and said, listen, we'll use the same mechanism, except if the market gives you 14%, let us do a system where you get all the upside, which is a unit-linked product. So the idea would be you choose your fund, you invest in it for a certain period of time, and then it grows to a certain level. The problem really is that there are other mechanisms to get the market upside, and there are other mechanisms to capture the insurance part of the same thing from the insurance companies themselves. So a typical insurance product would cost you, say, 300 rupees per lakh. That means if you wanted a lakh of rupees of insurance, typically a 30 to 35-year-old would pay something around 300 rupees per lakh. In fact, even lesser nowadays, 180 to 190 rupees today per lakh of insurance, which is very, very small. Now, if you think about it from a perspective of if I had 1,000 rupees to invest, then I could just say 300 rupees for the 1 lakh rupees of insurance cover, and the 700 rupees could go into a mutual fund. Now, if I did the math around this, the ULIP structure would get me from, say, 1,000 rupees to 10,000. But if you did this with a combination of term insurance and a mutual fund, you would get to 25,000. And the same returns. I'm talking that's because the ULIPs had so much commissions and so much things built in that it was impossible for you to figure out what that meant. So, for instance, if I told you that over 20 years, you are going to make 10x your money. I mean, I'm just paraphrasing, or you say 20 to 25 years, you're going to make 10x your money. It sounds attractive to you, saying, oh, I'll put 1 lakh rupees and now in 20 years I'll get 10 lakh rupees, 25 years I get 20 lakh rupees. And then when you work it backwards to getting only 10 times your money in 25 years is actually a lousy proposition in a lot of ways. So you actually find that the way it is sold to you is different from, say, anybody else. And mutual funds can't guarantee returns, right? So they can talk about their past returns being 11 or 12%. In 11 or 12%, your money is doubling every, say, 12%, your money is doubling every 6 years. In 25 years, you will get 16 times your money just by a 12% return. That is the average formula to think about. But nobody can sell you that. Nobody can say, listen, give us money for 25 years and we'll give you back 16 times your money. Though that has actually happened over the last 25 years. But, you can't sell it like that. The insurance person can. So they use it. They use this as a mechanism to say, listen, you know what? We'll give you 10x your money in 25 years. And because you don't have this mathematical system running in your head that actually tells you that 10x in 25 years is a crap return in the long term, or that there are better returns available on mutual funds, you simply don't have the ability to kind of digest this. So the problem with ULIPs is they're much worse products than mutual funds, but they're so much better than the traditional insurance products that they almost seem like saints. It's like, if you go to a gang of murderers, the person who's only murdered one person sounds like a saint in comparison. So
Sure.
it's,
Well, look, I heard what you're saying on this, and my sort of, if I may say, pushback here is what is strange about the fact that people are selling their product in the best possible light. Byju's is under so much flack today, and from what you heard, they would also go around selling you a course that wasn't perhaps that good, that you really couldn't afford, and preying on your sense of upward mobility, insecurities, and so on. This seems to be the case with all sales. Everyone is like trying to pitch you that their product is going to be the solution to your life's problems, even though it probably isn't. So why are we uniquely singling out these, if I mean, in this example, say these insurance companies which have just managed to market and sell their product more successfully? They're not lying too much or more than anyone else, perhaps.
Exactly. I think this is a great point, because I think there are two things over here, and I'll name them. There's a asymmetric information and there's an abuse of trust. I'll come to each of these first, but I think we've gotten smart in a lot of products, right? We've gotten smart in a lot of products because if you go to, and let's say you're watching the IPL and there's an ad that there's a guy wearing a dentist suit says, and this Colgate is the best toothpaste or something is the best toothpaste. You're unlikely to believe the guy. In fact, it used to be a problem for me when my kids would watch some of these things and say, they're the best toothpaste, we should have them. And I'd be like, no, they're just saying this. Now,
this actually happened.
This actually happened at some point. And no, they're the best. They said it on TV. So, but after a while, now the kids are like switching off the ads because they're like, no, first of all, I don't like them. And second of all, they're all giving you false information. So you've learned to go beyond the naive in traditional advertisements, right? I think the idea over here doesn't translate well into finance because of the abuse of trust. The abuse of trust would be that I go to a banker because I don't understand much about finance. The person who is your advisor or the banker or whatever it is gives you a certain piece of advice. Now you have no reason to mistrust this person, but the person is actually not at some point giving you the right financial advice. Many of them are not like this. For instance, in ULIPs, they're supposed to tell you what it means when they say 10x your returns, or there are hidden costs to a certain.
Or the example I have is they could tell you that, by the way, do this and you won't get your money back for so many years even if you change your mind.
Yes, there was a product with 100% commissions in the first year. And you obviously don't tell your customer, listen, sorry, the first 2 lakhs a year that you give me is gone. From the second year onwards, we will invest that money. Because if you told me that, I would not give you the money. And therefore, they're not acting in my interest. They're acting in their own because it was a 100% commission product. So this asymmetric information, they have the information, they're willing to hide it from you or not willing to disclose it to you in a certain manner is one layer. And then the abuse of trust, because you've got the problem of your being manipulated into thinking this product is right for you, whereas it is actually right only for the other guy that is in there. So the problem is this stretches into, I start off trustworthy, and then I get into this extreme mistrust where, how do you know a banker is lying is when he's opening his mouth. It's that level, and then there's no middle ground to this, and then at some point, things break down. So I think the problem comes from the fact that this abuse of trust has become pervasive and to a certain extent unpunished.
That was going to be my next point. Look, so I've met, again, I'm not claiming to be representative of much more than, say, the 10 people who I've met over the last several years in this regard. But these people have got burnt. They've all signed up for something that they had no idea what they were signing up for. They go to extricate themselves and they can only get out of some small amount, some many years later, the CAGR on it is, the return on it is very substandard. But there seems to be no ability to do anything about it. I mean, they're almost like, far from naming, shaming or being angry, they're like, I was the idiot here. I should have known better. What else did I expect? They seem to bring it on themselves and not go after it. So can you tell me, I mean, why is there no ability to do something over here?
This is actually amazing, right? Because you actually get to a point where a customer blames. You never find this in most other fields. You won't find, like, if there's a problem in a plane landing, that you would blame yourself for being, other than
for not doing better.
Yeah, you couldn't, like, for instance, you're sitting if there's a problem, you're going to wear your seatbelt. That's pretty much all you can do at this point, right? But the financial guy is more like, oh, I should have known better. Why is this? I think the first part of things was, most of your advisors were your relatives, right? So the LIC uncle was an uncle in every single family who pretty much was going to be the person who said, Ocha, aao, come sit down, I will explain and I will send you this insurance policy, and then you have to buy it. And sometimes, for instance, in my family is full of bankers. Sometimes there would be these targets, and to reach those targets, you had to open a bank account. And then I have bank accounts open from very, very long ago, which I don't know what the status is because it was open primarily to meet a target. And insurance too, that happens, right? You kind of do this. You can't sour a relation because someone sold you a product and they are relative, unless of course you want to break relations completely. But in general, the answers that you'll get at this point would be, listen, I know this is not a great product, but you know what? You will spend that money anyway. It's better that you have a substandard product than for you to have spent the money. I don't think that's a wrong answer, considering some of the profligate spending that certain people do. I was not one of them at the time, and I still am not. I don't think I spend in a way that is beyond my means, but I think to some people this argument would have still made sense. That's also why you don't get repercussions. But let's say it's not a relative. It's, nowadays it's mostly a person who's in the bank. You go to the bank, they look at you and say, sir, you're come to deposit your money. Why don't we sell you this fantastic product? You say, okay, well, fine. You're saying it's fantastic. You look smart. So you must be right. So therefore, let's buy this. Now, you go in there and after a few, let's say, months, discover that you meet this person, meet Shray, and Shray says, dude, what is this? You bought a 4% per year policy. You could get better in a fixed deposit. And then I go back and I'm like, okay, what did I do? This guy said it was the great thing. I go back to the bank. He's no longer there because they rotate, they move jobs, they move to different places. I can complain to the bank. The bank's going to be like, listen, we earned a commission. I don't care. And plus, it's impossible to locate and actually say that this person actually said that because you didn't record the conversation at the time, right? So you don't know this. And then, a lot of stuff gets missold like this. So, for instance, there was this product called HDFC Crest, which was a product by HDFC Insurance. Now, the insurance company shares the same first four letters, HDFC, as the bank. They both have a common owner, the HDFC lending company. Now that lending company is merged into the bank, but I'm just saying that, the owner was the same. But because they could use the same name, people thought it was a fixed deposit. So it was a ULIP that was being sold as if it was a fixed deposit, saying, oh, if you do this much, then we'll guarantee this return and so on. HDFC Crest was being sold to people who were old, who were going to retire, or who were even post-retirement. And for instance, my 64-year-old mom at that time was sold this product. Despite my expressly telling the bank people, please don't sell products to her. Talk to me when you need to sell products. They tried to pitch it on her, and then she was a little uncomfortable. She called me up. I had to call back, scream, and that day I made a video because I was so furious. This was 2012. I remember that somewhere through the networks, somebody asked the question, who is Deepak Shray from HDFC Life? Because apparently that video became famous. And even now, if you search for HDFC Crest, I'm like the third link. We're the third link in Capitalmind simply because it says don't buy HDFC Crest. It is not a fixed deposit. And it was being sold as one. And when people saw that headline, they were like, wait. I was sold this product and I was told it's a fixed deposit. So, but guess how many people have been indicted, talked about, how much of a fine has anybody paid in any of these products? Answer is zero. Not one person has suffered even a microscopic fine, apart from having to explain why some people like Deepak Shray have made videos on this topic. Beyond that, I think the discomfort has been zero. You've got problems with things like so many things in the mis-selling space. Recently, about a week back, SEBI started to go after certain people who were being missold products. They went to mutual funds and said, listen, you have these products which are 5-year lock-in products. How come you've sold them to 75-year-old people? Why are retirement products being sold to people who've already retired? Why are these products being sold to companies which technically can never retire? What is the rationale behind it? So they're trying to attack some of this. And I think at some level, that is the layer of repercussion you want from a regulator. But in RBI's and IRDA's case, I think it has been sadly lacking.
So fair. I think the customer basically feels, or the victim in this case feels, that they're up against behemoths and they should have known better. And even if they complain, who will they complain to? And it's just not worth it, I guess, at some level. Take it. Fine. So starting off on ULIPs, I'd like to move to something very different, which you've also talked about in the past. 81 bonds. I forgot what they stand for, but
additional tier 1.
Additional tier 1 bonds. But I do remember this quote, which I just found, and it's very memorable. So Matt Levine, whose newsletter I at least like quite a bit, he says that 81 bonds are basically a trick to investors or customers, I guess. They seem like bonds. They pay interest. They get paid back in, say, 5 years, and they feel pretty safe. To regulators, and I guess to the bank or whoever issuing them, they look like equity. If the bank runs into trouble, it raises capital by zeroing the 81 bonds. So if investors think they're bonds and regulators think they're equity, someone is wrong. And it's fairly clear through repeated history that the investors or customers are the ones who are wrong. So with that as the intro, where do you stand on 81 bonds? Because this has been proven. You have podcasts with me and articles on this talking about how this has gone badly for people. The asset class still exists. It's still being sold. It's still being bought. Where do you stand on this one?
Incredibly forgiving, because this has hit us on the face 3 times in the last 3 years, and it still continues to be a lucrative, sold as a lucrative instrument and bought as one. This illusion, these 81 bonds, just to give a quick primer, the idea of 81 bonds is that they're actually not even called bonds. The industry calls them bonds, but the regulator calls them 81 instruments. 81 instruments sounds like, in a band you have the background conga and bass and all that stuff. And you firmly believe, if you are not a music aficionado, that if some of these instruments are not working, the music would sound almost exactly the same. That's what 81 instruments are supposed to be. One of those really, they're not supposed to be the forefront of earning returns or whatever it is like that. It was supposed to be a small thing that was supposed to shore up bank capital reserves. The simple idea was that if a bank needed to lend more, it needed more capital. If it were to issue more shares, it would dilute everybody else out of existence. So instead, what they would do is issue this 81 instrument. And the 81 instrument said, listen, if I'm not going to go bust, I'll pay you 9%. And then you're supposed to ask the question, what if you go bust? And when you ask that question, they'll say, if you go bust, we go bust.
Too
bad. Too bad. And then you're like, no, tell me a little more about that. Well, you know what? If we go bust, first you take the hit and then everybody else. And then you're reading this as, well, you call this a bond. So technically it means first the shareholders take the hit, then I take the hit, then the remaining bondholders take the hit, right? So it's like the order of sequence of things. But it turns out, no, the fine print is like this. No, you take the hit. The equity holders don't take any hit. It's just you take a hit. So you take a hit before the equity holders is not even equity. It is worse than equity. It is like a toxic nuclear bomb thing that sits on a balance sheet, which if the bank is hurt, it explodes first and ruins itself, and then everybody else is still safe.
Equity downside and debt upside, basically.
Yeah, equity downside and debt upside. And the best thing is, you would actually do better owning the actual equity of the bank, because at least here you have the upside, and B, you have the 81 bond to protect you. It's like, you're wearing protective gear. The protective gear is going to get hurt first and then you are, right? So you're getting the protective gear and there's no upside for the protective gear at all. So the issues happen now 3 times. First, Yes Bank goes bust and gets some 10,000 crores of 81 bonds get written off to zero. Who have these 81 bonds? You would think that mostly,
you're calling them bonds again, by the way.
Oh, sorry, yeah, 81 instruments. There you go. 81 instruments. So who has 81s? 81s was owned, let us say, 50 or 60% by rich people who finance the bank itself. So you'd go in and somebody old would come in and they say, sir, our bank is giving you 7.5%, but we have this 81 bond that is giving you 9%. And you're thinking, what is the same bank, 7.5, 9%, what difference does it make? Let's buy it. Nobody reads the
Because if something terrible happens, you assume the 7.5% is also at risk.
Also at risk, right? So you don't think that that's not at risk. And here, specifically speaking, the 9% went to zero. You didn't get 100 plus 9 rupees, you got 0 rupees back. No 9, no 100. No principal, no interest. So Why did RBI do that? Is RBI said, listen, this bank has to be rescued. It has no capital, and I'm going to, whatever you write down as the IT1 bond translates into capital. It's effectively, it's like me giving Shray, you give me a loan of 10 lakh rupees, and then Shray decides that, Deepak, you know what? Don't worry about it. Don't repay me. The income tax department is going to be like, fine, you can say that, but that effectively means Shray gave you 10 lakh rupees, and therefore that 10 lakh rupees is income on the year that Shray writes it off, right? So anyone who writes off bonds for the other party whose bonds have been written off are for them it's income. So effectively what 81 would do is create income and therefore capital for the bank, and therefore it was giving this protection. Happened with the Yes Bank. Happened with Lakshmi Vilas Bank.
Nivas Bank,
or I forget what the name was now. And then it happened with Credit Suisse. Nobody thought Credit Suisse would go bust 10 years ago. They issued 81 bonds. Everybody bought them. In India, one of the biggest owners of Yes Bank's 81 instruments were mutual funds. Because they held the mutual funds and they said, oh my God. And it turned out there was a crisis because a bunch of corporate entities also held Yes Bank 81 instruments. There was a company called Indiabulls Housing Finance. They went to court actually. In that court case is still going on, where they owned 81 instruments. And a bunch of other companies also did it. But mutual funds. And when you talk to mutual funds, they say, why do you buy this toxic instrument on your balance sheet, on a mutual fund, which is supposed to be a debt instrument? Oh, we weren't aware that such a situation will happen where they will write down the 81 bonds but not the equity. So Yes Bank shares continue to trade, but luckily they didn't do this for Credit Suisse or for this thing. I think Credit Suisse it was merged in, and then in Credit Suisse also they didn't have to write down the equity at all. They didn't have to. And same thing applies with Lakshmi Nivas Bank, is Lakshmi Vilas, no Nivas, I forget the thing, but that particular thing was also one of those things. Now, the next thing that happens is Deutsche Bank goes and says, oh, we have 81s. Everybody's like, give us some 81s. And I'm like, excuse me, haven't you had like 3 large volcanic eruptions? Are you going to build a house in that same area?
On that, apparently you are, because just a couple of weeks after the Credit Suisse one, I was sitting across the table from someone who said Deutsche Bank 81 instruments are trading at a 25% yield to maturity, I guess is the way of expressing it, right? And proceeded to buy these right in front of me. And I was like, okay, I guess. But here my question is this really a problem of customer forgiveness, or is this a problem of, if I may call it, just customers just not acting rationally? I mean, where do you stand on this?
There could be 2 factors. So for instance, one, you should always buy when there's blood on the streets, right? So you make that risk assessment and say, well, Deutsche Bank won't go down in the 10 years that this bond is supposed to be in existence. Fantastic. Because you can take that, if you take that risk and you know that it's a risk that it'll go to zero, fine, that's a different thing. But if you go down the route of saying, no, this is just another bank bond, forget, Yes Bank was an aberration, so was Credit Suisse. Nothing will have to happen to Deutsche Bank. If you're under that assumption, I think that's where 90% of the people that buy the bond come from. And they're like, this is not even information asymmetry. At this point, I'm almost like, listen, you have the axe and you have a foot and you are directing gravity towards to chop off your own foot at this.
So sort of, I think I'm now more on your side on this one, which is the point that, yeah, you could claim that customers are the ones who are doing this to themselves. But the fact of the matter is that we don't live our lives trying to understand financial instruments well. So if there's something out there that looks like a bond, you assume it's a bond, and everything else is surely fine print that won't matter. And that's how most people are supposed to lead their lives. You're not supposed to go around reading the fine print on these instruments.
Decoding financial instruments, the way you say.
All right, Deepak, but when I look at the case of, say, investment managers, and we're one of them, right? We run a PMS and an AIF. I have mixed feelings about how forgiving customers are. The anecdotes I remember are, of course, customers who get very upset with, say, underperformance or something and they leave. And these ones stick with us. But on the other hand, there's also a fair share of people who just never seem to check in and who seem to do reasonably well. How would you think of customer attitudes towards their fund managers? And there's a lot of us, right? I mean, mutual funds across the world and so on. There's also hedge funds and so on. Where do you feel customers err, or how do they react to fund managers and their pros and cons?
This is actually a very tricky subject because we are fund managers, like you said, so we'll always look at it from our side of the angle at some level, but we're also people who've been through the fund management journey enough to say that, listen, there are fund managers who aren't doing exactly what is in the best interest of their customers, and over time my views have, perhaps I can appreciate the fund manager side of the equation sometimes, but I also appreciate that the end investor would have certain kinds of questions and should have certain kinds of questions which need to be answered. But on the forgiving nature, let's look at some examples of where you've seen something that is outright surprising. There's this most famous example perhaps is if you have read this book called Liar's Poker by Michael Lewis, which made him big. Michael Lewis wrote about it as something about a situation in Salomon Brothers where they were trading junk bonds, and the junk bond unit was run by this guy called John Merriweather. At some point, this particular situation got so bad because they were so over leveraged owning and trading junk bonds that Salomon went bust, in the sense of they needed to be rescued, and the rescuer turned out to be Warren Buffett, who literally said, John needs to be fired before I get in there because the situation is very rough. And apparently he was not happy with the attitude of people who were asking for money, which is in Warren Buffett's case typically a more less, let us say, arrogant style of functioning, and perhaps the financial world is filled with people who come naturally with arrogance. I'm not saying this is a bad thing. Sometimes arrogance can be a sign of confidence, and confidence is always a good thing. But at that time, it was clear to the world that the situation, because at least Warren Buffett had mentioned that, he needed John out, that perhaps John was responsible. So yeah, you might say, okay, well, that's fine. It's a performance. It's just bad performance. Let's move on. He starts another company called LTCM. Again, LTCM, which is long-term capital management. Big books have been written about it. Very good one by Roger Lowenstein, I think.
That's the When Genius Failed.
When Genius Failed, a fantastic book. He's a great writer. And interestingly, he has a book on Buffett as well. We should probably do a book podcast at some point for all these guys. But interesting situation here was that LTCM worked on something called an arbitrage trade. A very interesting small that you use arbitrage to say the prices of two things that need to be roughly the same are not roughly the same, and they will become the same at some point. Because the differences are in small basis points, 0.01%, 0.02% type thing, you take a lot of leverage to amplify that 0.01 100 times, 200 times and so on, and then make your super normal returns. LTCM did that for 3 years until it found out it was over leveraged, and it was the elephant in the room, and the market kind of went bust. LTCM was, of course, started by John Merriweather, but also had Nobel Prize winners as part of its senior team. So I think, when it went bust again, you'd think that, okay, well, the two big times this guy's leveraged himself up the wazoo and lost money. So at this point, when LTCM went bust, you would have thought that, maybe they're not good. Maybe the 2 performance strike is going to affect him. He starts another fund called JWM Partners, does very well over time, but has an issue it starts just before the .com thing. He had a hit in the .com, but eventually grows the assets like 10 or 12x by the time, I think it was 2007 or so. And 2009, the fund goes bust because they bet on subprime and a bunch of things, and the thing goes bust again. It took 3 strikes because in 2010, he tried to start another fund. And that fund raised only some $28 or $30 million, which would have not been enough to do much. So it was surprising that he got forgiven for the performance over a period of time, when you might just say there are 2 parts of this. One is you perform. Performance is a part of it, is luck. But when you over leverage yourself, it's an active choice. When you over leverage yourself to the extent that you take the fund bust, you lose 100% of your money. That is, I think, a little extreme. So when you do that, the part of it is a personal, that means it was an active choice versus something that was passive, that the market came and hit against you, right? So at some point you have this feeling that, listen, this person is just too risky for someone to bet on, and perhaps that's an issue. On the other hand, the people who don't do that, for whom, for instance, the market is the problem. Right? It was not there. They did everything in good faith. And then, so we're forgiving for those in a much bigger way. One of the examples is a famous fund manager who was heading one of the largest, at the time, the largest Indian mutual fund. And he bet a lot of money on PSU stocks. So for 10 years, this fund underperformed because PSU stocks were going nowhere. About 2 years ago, PSU stocks started to move up. He literally put in his papers after they started to move up, and then he waited until they actually gave us decent returns. So he left on a high note. But the year after he left, they gave the most phenomenal return ever.
I experienced it, so I know.
So it's amazing to see that. I mean, for 10 years, we were forgiving because this fund remained one of the largest. It's the second largest active managed fund in the country and the third largest total mutual fund in the country even now. But the point here was we were forgiving of him, and he was probably right. And he was right to a point where in his perhaps layer of frustration around these stocks, there was an issue of, okay, I need to leave at a time when the time is right, and the time was right much, much later. Investors were forgiving because they were not taking out capital in any meaningful way. You take his name and they would be like, okay, look, he's a good guy. He just selected the wrong stocks. And this is not, malicious in any meaningful way. So obviously that's right. And I think that is the difference now. We slowly start to make a difference between what is malicious behavior and what is non-malicious behavior, right? So even a Warren Buffett, if he has a 10-year period of underperforming markets, 2007 to 2017 or 18 or something like that, people are fine because that's Warren Buffett. He did his thing when he did his thing, and then 10 years he didn't perform. We still take his word to a certain extent for gospel because he says very nice things. It's not that he practices those very nice things that he says. It does not matter because you like the way he says it because it inspires you. And I think the idea over here is, how long will people forgive you and for what?
Okay, I'd like to jump in because you've given now these examples of, can I call it, forgiveness if we want to use that word, but also just extreme patience or giving multiple second chances, third chances. Maybe perhaps what is justified is where you're going with this. But then now I might be butchering this example, but I think DSP or another mutual fund had given an example where there was, I guess it has to be a small cap fund because nothing else could have done this. Some small cap fund that did, let's call it 10x in 10 years or something like that. And I think the ad rang out as less than 10 people had stayed with the fund from the start to the end. So here I feel that maybe not all customers are that forgiving or patient, and they're very likely to churn. So how does this sort of work as a counter to the point you're making that people are extremely patient and forgiving? This
here is where the other side of the equation comes, right? So you get the let's give an example. This 10x if you have a 10x in 10 years. The example I heard about, this was 2 days back, somebody sent me a mail saying, you should only be opportunistically in small caps, which means if the small cap return has been fantastic for a year, get out and then come back after 2 or 3 years. Now, my problem with this is 2 levels. There is the data that does not say that you should do this, especially if you're a 3-year horizon person. There is no reason why small caps, even if they give you good returns in any given year, that you shouldn't stick on with them for the next few years, because it could happen that the next few years may also be decent enough for you to stay. But the second problem is that if people are making these assumptions that small caps are more risky, therefore I should not have money in them all the time. This makes sense for a fund manager to decide, but for a person to decide with a more passive investing thought process makes no sense at all. So at some level, that is, I think, a problem. But once you get that in your mind, you're almost like, I have to take action. I'll come back, and then you always come back at the wrong time because you'll end up coming back when the market's up 30%, the small caps are up 45%, and you're like, okay, now I'll get in, and then usually that's where the problem is. But the counter example also has issues because, for instance, there's a fund manager in 2017 who bet a lot on small caps. And he made a very good return. He was famous. He was coming on TV all the time. And then people liked the personality. They stayed with him. When the market completely fell off under him after in 2018 and the government,
it was awful, right? It fell like some 70-80%.
Yes, unfortunately, and perhaps it was his stock selection that did it, because he specifically said, I think the bad promoters in the country are becoming good. So the people who were acting in bad faith, the promoters who were acting in bad faith, who had siphoned off money. People knew they had siphoned off money. Some of the stocks were starting to perform well. And his assumption was that, listen, things have changed in India and they're going to continue to be well because, you know what, the government has gotten more strict and all that stuff. Turns out they didn't. And therefore, he lost money. And his customers lost money to the extent that he had to tell people that, listen, if you want to take your money out, I can't sell these shares because they will destroy the market if I do. Why don't I transfer the shares to your demat accounts and you guys can sell them when they want. And this became a big thing. The forgiveness nature had then translated into a situation where while we forgive you, we don't like the fact that you have said all this stuff and all that. So maybe the fact that you invested, he was probably right in his assumption that things will change because over time, a lot more companies that were otherwise hitherto bad in a way, it turned to good for many reasons, including the IBC. We've discussed this in another podcast, but the change in thought process has sort of happened. But if that forgiveness was there, it continued to stay because most of his AUM continues to be with him.
And I have to say, in our office, even though no one actually follows him, but the fact is people are generally supportive of him, saying this is a live by the sword, die by the sword thing. I mean, go have fun. I mean, and stop complaining when it actually falls. But,
which is true. And so if I believe here that there was no bad faith. That from the part of the portfolio manager. He made a bet. He said, listen, I think I'm managing your money well. I think these companies are going to, if they actually were shifting from bad people to good people, that they're actually going to give you super normal returns. They did for a while. In fact, if you had held on from there to now, you'd probably make a phenomenal return simply by him because it was, some of those companies turned out a fantastic return.
Basically, stay in small caps.
My thing is, at some point, the small cap world is not for the faint-hearted. But if you're not faint-hearted, why do you want to behave faint-hearted when things change? So I think that there's a thing that I'm coming up. What happens typically is when people get really angry about performance. And now I'm going to talk about the people who are now unforgiving, right? So if you're unforgiving about performance and you don't make a differentiation between bad faith and bad luck or bad performance, at some layer, you have a penalty to pay. And I'll give you an example. Howard Marks talks about this in one of the, I think, podcasts or interviews that he had. He said, we had these people in 1999 as customers. They hated the fact that we were not in .coms. And we said, listen, we don't want to be in .coms because we think this is a whole tricky place and it's terribly overvalued. Now, remember in 1999, things were so bad that the markets were first up 40% in February. They went up another 50% by November. Then by the next February, they were up another 60%.
I wish I was an investor that this would have been quite dramatic.
This was unbelievable. I mean, it was the kind of thing that said, listen, I walk into, in the morning, in the evening in India, that is the time, and come out by the evening and you're a rich man. And in the face of that, we were underperforming, said Howard Marks. And he said, listen, a lot of people took their money out from us. And they took the money out at the wrong time. They literally said, we want to be participating in this insane, magnificent rally or whatever it is called. And you guys don't know what you're doing. You should not be given a fund management. A lot of bad things that they said to Howard at the time. And they were really, really upset. And he says, 2 years later, we were proved to be right because there was a massive .com bust in 2000 where the stocks fell 80-90%. Some of them went to zero. And yet, when we evaluated our fund, two things had happened. First, that we had seen a 2x or 3x increase in AUM in 2 or 3 years. That means we actually got a lot more money. But we also noticed that none of the people who were really upset ever came back. Even though we were right, the problem that they were having was not that we wouldn't take them back, but they didn't want to face the feeling that, listen, we're going to go back to Howard and we're going to have to say, listen, I'm sorry I said all those things to you. You were right. And that feeling that, Howard will say, well, I told you so. It probably would or he probably wouldn't. I don't know what the thing is, but I'm sure some of his salespeople would be like, listen, you told me all those things. Now let me get a little bit back at you and all that stuff. So if the feeling that they would actually be subject to it would probably have put them off putting it and saying, listen, I know Howard was right, but I'm not going back to him. I've seen this in other behavior also because people like somebody is bad and then when that somebody bad turns out to be good, you're almost like, okay, but you know what? I was not happy. And it's happened with us when some of our customers leave us at the time and we're actually telling them, listen, it's not the right time to leave because you're in the midst of relatively bad performance simply because the market is like this. But the market will change, and when the market change, fortunes change. disproportionately for a strategy like the one that you invested in, typically. But they will not come back. And, at some level, we also don't want to go back to them and gloat. But, maybe internally it would make us a little bit happy. It's not professional.
No, I hear you on that, and I completely get, the human nature and the professionalism aspect of it. But I have to say, as a customer, I feel very wary of, like, look, when I give you money, or you, not the you, but a manager money, I get bad behavior should never be tolerated by anyone, either the manager or the customer. But this doesn't feel like a great power dynamic, right? That when I am disappointed, I can't say anything because you're saying that it'll probably just poison the well or whatever, and you yourself will then make bad decisions. This doesn't feel like a healthy situation to be in for anyone.
It isn't. So I think we should then separate out the two things. One is when there's bad performance. And there's bad performance, if I choose to exit a fund, then it is my bad if the fund starts to perform well immediately after. It's not the fund manager's fault. So it was bad performance, I took it. But if it was bad behavior, so if you find out that in certain cases, to give you an example, perhaps, there are situations where there is bad behavior, and we'll come to that at a later point. I think we should make the point earlier about what happens when you have this disproportionate power equation. The disproportionate power equation creates a situation where, let's say I'm unhappy with this thing, and I go to the fund manager and I yell at them, and and say something like that. Now I am just airing my frustration. In India, sometimes there is also
fear, frustration,
everything.
All that stuff.
So you do that. And then the problem then becomes that the fund managers themselves are so they're sensitive to this, and at some point, you have so many stresses to take in your life. At some point, you're like, I don't want more stress. What happens when that fund actually becomes successful is the fund manager says, fine, I was in a bad time and you hit me when I was down. So I'm not going to take money from you or from anyone ever again, which is what happened. Michael Burry of the famous Big Short fame was, I think he's on the autistic scale. He's got Asperger's syndrome and all that. But he was very right about the subprime crisis coming up. Unfortunately, he was right about it in 2005 when it was way before the subprime crisis ever hit, from 2005 to 2007. So he was short.
So he had a painful 2 years before he was proven right.
And during the painful time, the institutional investors also, people like
were very painful to him.
Yeah, were very painful to him. They were to the point that they went and said, we want to take our money out. And he used an often placed but never used rule that said that a hedge fund manager can say, I am not going to allow you to take out your money until the end of the X period. And that by the end of that X period, he had actually returned many times because the subprime crisis had already hit. But he got so unhappy with it. He returned everybody's money and he wrote a letter, or maybe there was some other fund manager. One of them wrote a letter saying, "Listen, I don't want to do this again with external money. Now I have enough money of my own and I'll walk away." Another famous guy is this is a guy called John Arnold. Now this guy, he's probably the interesting characteristic because he was really good when he was doing this stuff. He started a fund after Enron. He was working in Enron. They gave him a portfolio to manage just while they were turning bankrupt. He managed to earn $1 billion more off the fund just before Enron went bankrupt completely. They were supposed to pay him some percentage of those profits, and they said, no, we're bankrupt, we're not paying. And then he went on to start this company called Centaurus Energy. They would bet. There was a trade called the Widowmaker, and maybe we should do another interesting thing on that. The Widowmaker trade that John Arnold, it was about natural gas futures and how the spread would vary between summer and winter, or winter and spring actually. And he eventually took on this guy called Brian Hunter, working at a company called Amaranth Advisors. Amaranth went bust because of this trade. And John Arnold ended up making $750 million to $1 billion, I don't know, some crazy amount of money in that trade itself. His fund had grown at least 50% every year for about 7 years till 2007 or 2008. And suddenly he decided, enough is enough. I walked away. Most of the fund was his own money. He walked away he calls himself a philanthropist. So if you look at to Google for John Arnold.
But that's rebranding every rich person does.
Yes, at some level, yes. But it's interesting because at some layer there was that also, that you made your fund manager successful, and maybe he is so unhappy about managing other people's money that and he's sensitive. You need a thick skin to be managing. In fact, you need a thick skin to be alive nowadays. But when people don't have a thick skin, they will walk away. This specific reason, I think, has this differentiation. You hit a person for bad performance but not bad behavior, then that person walks away. But if you hit a person for bad behavior, I think that's still fine.
I actually do take your point. I think just the worrying part is, though, the implication of this is you may be a particularly, if I may say, understanding, well-behaved and methodical customer who doesn't look at the short term and gives people a long rope and all that good stuff. But it can be someone else's actions that completely, sour the relationship with the fund manager, and then this fund manager just leaves. Again, the power dynamic doesn't feel great, assuming the fund is successful and so on. But I guess the other way of putting it is that there's hundreds of funds out there, so you can equally just pull out of one and move to another.
At some level it is commoditized, but also some at level there is a superior. It's like saying a degree is a degree, but then an IM degree is not the same as a degree. But I think we have to also analyze a little bit more about bad behavior. You have the issues that you have that I would say require you to be a little unforgiving. I'll give you an example. They were the promoters of Z. The promoters of Z ran a bunch of personal companies called in the name of SL. Now SL went bankrupt. SL had placed the promoter Z shares as collateral against loans and bonds that they had issued, and mutual funds are the subscribers to these bonds. Famous mutual funds, top 2, top 3 level of mutual funds. All fine. You're all good. Nobody would have thought, except people like us who wrote articles in 2015 saying this is a bad idea. Nobody would have thought that SL would have a problem. But SL's problem was that not so much that anything else, but the fear of that was Subhash Chandra, who's the promoter of it, was very powerful
and well-regarded
and all that. So when things started going to go south, what happened was SL said we can't pay. So Nippon went and took Nippon Mutual Fund. I praise them for their action on this. Okay, by the way, they go in and dump the shares that they own of Z, because when you default the bonds, the collateral goes to the person who has got the collateral. They took the bonds and dumped them. Z price falls some 40% in one day, and everybody's unhappy. The remaining mutual funds suddenly decide that, listen, we should not sell our shares. Now, it is not really their action to decide. They should actually have taken ownership of those shares and then figured out what to do with them. But taking ownership of those shares would have meant that the Chandras would become a minority investor in Z, and that would have been considered to be a bad thing for Z itself, and a bunch of things. Z was part of the Nifty at the time, and it was such a big deal that a lot of actions happened, and the mutual funds actually did some strange things. So for instance, they would do things like, there was the debt was held in bonds. The bonds would move around between different kind of funds, because you could sell between two mutual funds of the same AMC, right? So you could say, oh, this fund has sold this bond and this fund has bought it, even though you knew it was defaulted. So there was a situation where some of these things kind of got complicated, and there was actual bad behavior.
They parked them in those fixed maturity
plans as well. Fixed maturity plan is not supposed to invest in something that is whose maturity is beyond a certain date of the fixed maturity plan, but they did it, and SEBI even dinged them for it. But you know what? They got no flack. There was complete tolerance of this bad behavior. Even though I would have said, you shouldn't even invest in any of the... we got to clean up the system, right? So the cleaning up actually didn't happen. Franklin had a massive situation with risk management. Now, you and I know, because we were tracking Franklin at the time, that, they were investing in not such great debt. We knew that they were earning supernormal returns on one of their short-term funds by investing in certain debt that is likely to have problems in case there were problems. COVID brought those problems together, and then there was no liquidity to be able to sell those bonds. The problem now, I don't blame them for taking the decisions they did on the other thing, though I think that some of the things that they did were putting in 81 bonds into short-term fund is a bad idea. But because 81 bonds have a technical maturity of, unlimited number of years and so on. The issue that you ended up having was that just before this fund did what it did, which is what it did was that it told people that you can't take your money out. We can't sell anything that we own. So we're going to give it back to you only when the bonds we hold mature or we're able to find a buyer for them, which could take a year or two. It did take a year or two and they did get whatever money they put in back. But doing that in a short-term fund is considered not good because you're effectively blocking liquidity when I was investing with you in a short-term thought process. But what preceded that was the problem. A bunch of people inside of Franklin apparently sold their units, redeemed their units when they were in the know that the situation was getting worse and worse. Franklin was actually borrowing money to make payments to investors who were leaving, and that borrowing had gotten to 1,000 crores plus. And therefore, you had the situation of being able to not return the money and all that stuff. So if I am knowing my company is in trouble, my selling of its units would therefore be bad behavior from me, right? So because not everybody else is aware of the bad situation. I think that was another thing. This bunch of PMSs they were called portfolio management services, mentioned in Sucheta Dalal's book run by public sector banks. Sucheta Dalal wrote a book called The Scam in 1992, and she talked about how big the involvement of, let's say, for example, Citi was in that process. And India was just opening up. Remember, this was a time it was a terrible situation for India, and we were trying to say, listen, let's get more foreign investments. And then Sucheta goes around saying the Citi is the culprit here, and she's right, because the things that they did against
were bad for customers, basically.
And we say Harshad Mehta is bad. Citi's operations were just as bad. They used a certain set of brokers to do things that was just as malicious, and yet Citi got away. We kind of forgave them, of course, to an extent that in the end, Citi did a bunch of other things later in not in the financial field, but they basically, when they were doing they were giving out bank accounts, they told everybody, listen, we'll charge you 200 rupees per month on insurance unless you say no. And many people didn't know what this whole thing was. After about a few months, they start looking at the statements and say, what the hell is this 200 rupees a month? Then you call the bank and say, oh, you know what? If you say no, we'll cancel it right now. RBI took notice of this. Citibank didn't even get dinged then. Of course, they got dinged, I guess, inside one closed RBI chamber. But nothing external happened to them. This happens a lot, and this is bad behavior, right? It's like malicious behavior. How can you charge me 200 rupees unless I say no? That sounds ridiculous. I have to say yes explicitly to you charging me 200 rupees. There are then in the mutual fund world, there are mutual funds themselves who will buy companies that are friendly to the group that owns them. It could be, so Aditya Birla has a mutual fund. Aditya Birla has a bunch of companies. Many of them are listed. How much of them are owned by the Aditya Birla funds? And therefore, in comparison, if you look at how the other funds own them, there will be a difference. So you don't know the difference. Some parts of it could actually be bad behavior. Some parts of it will not be.
So this one is a little harder to tell.
It's harder to tell because it could be an independent fund manager saying, I need exposure to this. But you can almost always bet. Almost always.
But on the other hand, if it goes the other way, then they'll say, why didn't you buy it? It was your own group.
Yes, correct. Exactly. It was your own group. So you'll end up having some. And mutual fund distributors, they might keep churning you. We've seen this example so many times where a mutual fund investment is supposed to be for a long term, right? This is the mutual fund distributor who's coming to meet you every, say, 6 months. He's got to have something to say to you. At some point, if you keep coming to him and talking about the weather and saying everything is fine, you're going to be like, why is this guy disturbing me? And then he might tell you, listen, you have to invest in a new fund. And you're like, oh, you know what, where my SIP is going on, let me just, keep investing. Now, for you to invest in a new fund, he has to take out money from somewhere. So he looks at one of your funds and says, oh, this is not performing very well. Let's get out of this and invest in this new fund. Maybe that's part of his job in terms of selling you this stuff. But it's also true that much of this churn happens because he wants to show you he's worth the time that you're spending on him and therefore the money that you're paying him eventually. Because you have to suggest action all the time. I think that actually becomes a pain point, which at some point is just churn for the sake of churn, and that is bad behavior. We forgive it because, just the same way you forgave your uncles for selling you an LIC policy, even though it was not probably the best thing for you. I think we'll forgive it at some level, but I think this bad behavior deserves to be not forgiven as much as it is.
Okay, fair. I'd like to move to something which I feel is a little more black and white. There's a lot of places online which claim to be selling you F&O education services or just investing education things. And they seem to, earn quite a bit of money, but not necessarily do very good for their customers and not help them get rich and not help them trade their way to wealth and riches within 3 years or whatever the promise is. Here you would think it's fairly black and white, and but nonetheless, these companies continue to do well, they prosper, and SEBI has often taken the stand that, look, at some point, I'm not here to protect everyone from, if you want to get rich quickly and you're willing to subscribe to something, that's on you. So where do you stand on this one?
This is actually so interesting from a different angle. We are actually trying to create, we have a subsidiary company which is actually a registered research analyst, and they are regulated by SEBI, but obviously a lot of the influencers who give their investor education are not. To give you one example, and one of the more famous ones recently talked about, I am not a financial advisor, but I'm going to give you financial advice. And that's also sometimes how we come across. So I don't have a problem with this per se, but sometimes it ends up being bad financial advice, not by design, but because of lack of an understanding of the emotional part of the equation or the performance part of the equation, both of them. Now, what happens over here, I'll give you this example to clarify, because it just happened today and I think I need to write something about it, but I don't know when. The issue is that there's this person who has a family and who's just about living hand to mouth. The influencer tells her that, listen, you have a 70,000 rupee interest payment. Now, the one advice that he says is, out of that 70,000, there's a 15,000 rupee EMI that goes towards your car. And she has this house that she might be able to sell for 60 lakh rupees. And she's like, what should I do with it? And his advice was, don't clear off your loans. Instead, invest the money in some stock market, and then you'll make more returns than the interest you're paying on the house. Technically, this may be even right.
I guess technically it probably is right. Over any long period of time, the house must be like, 8-9%?
9%.
Nifty,
yes.
12 to 15 or something?
Yes, and then so post-tax, if you remove the tax of it, it's roughly the same. But okay, let's assume that the case was whatever it was. The issue is this family is living hand to mouth, right? There's no savings at all. Instead, wouldn't it be better for them to just pay the loan, get their loan things off their heads, get the emotional freedom of doing so? And then suddenly now they have 60,000-70,000 rupees excess discretionary income. They can either spend it or they can save it, and they can save it and build a nest egg for themselves.
But isn't this your subjective call, Deepak? Now, you have your subjective view on this. This person had their subjective view.
I don't think this is a bad thing. That's what I want to come across as. I think it's not bad behavior. It is bad. There are actors who are influencers who are bad behavior. Now, the bad behavior is, I will tell you bullshit just to sell you a course. I don't actually have any experience in trading, but I will make a trading course. So I will create a company. I will lose 4 crores in that company by actually trading, but I will earn 20 crores by selling courses on how to trade.
That claim I'm very good at this.
And that I make money every day. I have edited screenshots. So I take screenshots of things. I use Photoshop and edit them and whatever and all that. Now, if you're going to do that, I would say that is downright fraud and illegal and bad behavior, and therefore that should be, confirmed. So, yesterday I heard about how in the US a regulatory entity dealt with it in a completely different way. They went and told a regulated broker that you didn't curb your influencers from making outlandish claims, so I'm going to fine you $250,000. So the broker employed those influencers to plug his brokerage. He said, you'll get $75 for every account you open. So he had paid out $750,000, but the fines involved, getting those back as well. Now, the thing that they did was they didn't go after the influencers. They went after the regulated entity. I think that may be a better way to do it. Saying, listen, you can't pay them. If they're going to go and educate people and do all this stuff, if there's a problem over here, it's a problem of fraud. But there has never been anything against fraudulent information. For instance, as an education, right? So for instance, if a doctor told us that a COVID medicine vaccine was perfectly healthy, we believed it. Now, nobody's going to go back and put a case against them and said, you know what, there's been linked to an evidence of X and Y and Z afterwards. So you should have never told us that it was healthy. But so the fact that it was bad, or it was even, in fact, the whole climate science thing, I feel a lot of it is just maliciously negative. But because it's education, even if I paid for a course for this, I don't think I can go back and say, listen, a lot of your stuff is just wrong, fraudulently edited graphs and so on. I can't do this. I mean, because just because I paid for a course does not mean that I am entitled to the truth in a certain way. So at some level, the onus of identifying and calling out an influencer who's giving bad information because of bad behavior comes down to us. Comes down to us as in everybody of us who will make that call. And you know what? In the end, it doesn't matter. Because if somebody tells you that I'll get you rich in 30 days, you are going to take that course because at this place you're in, you're desperate. You are going to find it difficult to say no to something that will kind of solve your problems, right? So at some level, I don't know how to solve this beyond the fact that if that person has actually done bad behavior, you should arrest him and put him in for fraud. But I think that, and then, sometimes people give you we've seen this Ambar Dalal case recently. That was an issue which happened where it was not education, but it was reputation. The person said, I'm a chartered accountant. I will give you 1.5% per month guaranteed on your investments. And he did this for 10 and a half or 12 years or something like that.
Which is quite remarkable.
Amazing. No, I'm so, it doesn't make you feel like this guy is running a Ponzi scheme. If a guy's done a situation like this, Ponzi's that when you use
of course,
money,
I guess you never know.
You never, I don't even know if it was, it may be perfectly valid that he did this in the commodities market. You can earn 1.5% per month and he paid out. Except that sometime there was an issue in the commodity market and that thing blew up and poor fellow got screwed and basically lost a lot of that money. And then maybe because he couldn't return the money, he ran away. He did in March and 2024. And then he was caught in Dehradun in some resort. And then he's being brought back for questioning. Turns out he has properties in Dubai. There were 500 crore rupees of investor money that was lost or technically has not yet been found. So all of that stuff is there. But what happened there was, I don't even know if I can blame the guys who invested. Because for if you give returns for 10 years, every month on the 10th of every month, people's accounts would get credited with their 1.5% interest. How do you ever know that this person is a fraud? The only thing I will say is if you don't know where the money is coming from and where it is coming from so guaranteed in some way, that you should absolutely question the source of it as being very risky. And if it is very risky, then, the risk is hit you. That's all.
I thought of something else. There's an entire asset class as an investment, which is startups, right? Investing in startups, or angel investing, if that's a better word for it. And especially as people have had exits from their own companies or wealth has increased, people have started using this as an investment avenue. I think there's the rule of thumb is apparently 90% of your investments will lose money. The 10% that make up for it, it's some power law thing, and they make so much that you'll end up doing fine anyway. So people invest. Over here also, as you know, there's been a lot of stories where it turns out that the founders were actually just siphoning money off of it. And then they're still able to launch companies subsequently. Or there's actual bad behavior in these companies. So how do you think of these angel investments? And so on.
This is such a big deal for me because mentally I find this. So when we do this in public companies, when we find this, we find that it automatically raises a red flag in our heads. Now, every company has a red flag, but at some point you're like, listen, if it's a 500,000 crore company and the promoter is, stealing pens from the office, you're fine. I don't care, man. It doesn't matter. But if he's doing other things which are necessarily much worse, then of course you want to curb that. But let's say an example was WeWork. In WeWork, there was nothing illegal about it. The founder of WeWork sold a brand, the brand V, that he owned for $500 million to WeWork itself. And now when WeWork has gone bust and he's taken a big fat severance package and stuff like that, this is also documented in this Apple series, which is actually quite good, called V something. I forgot.
We crashed, I think.
We crashed, yeah. So now he's putting a bid back to buy it for $500 million. He's gotten funded by another VC to start another company, which was on a similar kind of scale. At some level, the problem wasn't that he built a business and it failed. He built a business. He personally profited from the VC money that was given, and he used it to his own personal advantage. And then the company crashed. Should have meant that, listen, we know that you may be a smart entrepreneur, but you've already taken us for a ride. We won't invest in you. That thing didn't happen, right? And I think in India also you've had a promoter who's say Rahul Yadav of say 4B Networks, who earlier had done some strange stuff with this housing.com, and there was bad behavior by his own in his own way of doing things that were not, well, at the time not palatable. Within housing itself, there were lots of issues that were found at that time, but he was asked, he left, then he got funded again, and he started another company where he apparently there's been a 250 crore hole that was created, and a lot of personal profiting has happened. That's what we're hearing on the news. But again, the feeling is that if he goes to the market again to look for money, he's likely to get funded again, because nobody cares, right? It's like,
I certainly hope not.
It's happening right now with another person who is, again, head of sort of founder of a company that was in the financial space, becomes a TV star of some sort, and then uses bad words and gets fired from his company. And it comes to light that the company has made large payments to a certain set of companies owned by his wife and his brother-in-law, who never really provided the services that they were supposed to have provided. And the only reason they were caught was because those shell companies, if you may, didn't even pay GST on that money, while the company had actually paid them the GST. And the GST department came back and said, those people didn't file for GST, so I'm sorry, you can't claim this GST. And that's when they uncovered this whole madness. And you know what? I think, again, if he goes to the market, he's going to get funded again. It's just amazing. It's, that you do. But I mean, much as I say this, I know that a lot of companies that we invest in also, there will be some promoter challenges. We have seen that sometimes we try to be this stupid player who's going to be like, oh, you know what? There's a problem here. Let me get out. I'll give you an example. There was a company called Polycab. We invested in it. And at some point, there was an ED raid. Now, Polycab makes cables. They make electrical cables. They were becoming a very fast growing player, competing with Havells and a bunch of other people. And the cables themselves are commodity, but the brands matter over here. And if your brand is getting better and better, you're getting better sales, and you're getting to a point where you're one of the largest retail players. You're getting to be one of the largest retail players in the industry, and they were getting to that point. And then this ED raid happens. Now, I think the space has enormous potential to grow. Electrical cables are going to be used in everything. However, when you have a news of an ED raid coming about, you kind of say, listen, there's maybe something wrong over here. Not ED raid, it was some income tax raid. I don't know which one it was. But you said, okay, something wrong over here. They're saying that they did not declare income of so much and so on. We said, okay, let's sell the shares now and wait while we get some clarity. The stock's up some 45 or 50% after that. And it makes us feel like, what, are we the only Harish Chandras in town? What are we trying to be a Harish Chandra? Or what is the point? It sometimes does backfire on you for having for unforgiving policy in certain cases. But I still like the company. I just want clarity on this situation. If the clarity comes in that, listen, the income tax department has withdrawn its demand, then I will still want to invest in it. I'm just, I don't think every company is super clean, but there will always be an element that says, I don't like what's happening right now. And I just think that bar on this startup situation and the internal frauds and all that stuff seems to be way higher, that you can get away with way more on those things than you can in, say, the public markets. Much as I hate to say it, sometimes it doesn't pay off financially to be so strict about morals and so unforgiving either.
Okay, Deepak. So now let's round out this episode with a counterexample, like a situation where you feel so far the whole thesis has been that customers are often too forgiving, too ready to give you a second chance. But what about situations where the customers are far from forgiving, are the ones who have the disproportionate power and perhaps are using it unfairly on some, well, I'm not sure what examples you think of, but poor, unsuspecting company which is only trying to do its best possible job. Are there examples like that in finance as well?
Yes, the sad part about it is sometimes it's, the perception is completely odd. I'll give you an example. If I told you two companies and I said, which one is more shareholder friendly, Tata's or Reliance?
I'll go with Tata's.
Yes, almost everybody will go with Tata's. But here's the thing. Reliance has actually been way more shareholder friendly forever compared to, I mean, I'm talking about the Mukesh Ambani and the Dhirubhai Ambani kind of that part. Right from the beginning, Dhirubhai Ambani in 1984 fought for shareholders because some short players were trying to bring his stock price down to the point where he shut down the exchange to ensure that the short people completely got ruined. And eventually, of course, there was a cartel. I think we did a podcast and we have an article about it. But what the Tatas did in the 1990s and 2000s was very, very unfair to shareholders. And what they did was, and even now, there's so many incidents I can tell you about, but in the Tatas itself, after Russi Modi won a battle or fought a battle for ACC on the board, and there was a big boardroom battle over there, the Tatas discovered that they had too little stake in their companies. ACC was a Tata company. Now, of course, it's an Adani company after passing through God knows how many layers. But there was a feeling that Tata did not own so much of its companies, but he didn't have the money to kind of buy more stake in all of its companies. So what did it do? It said, you know what, Tata Steel has, I don't know, 1,000 crores, let's say 500 crores, something. Tata Motors has some 300 crores. And of course, they could borrow more money from the banks if they wanted to, but they did that and then they subscribed to rights issues of the other person. So Tata Steel bought Tata Motors shares in the rights issue, and Tata Motors bought Tata Steel rights, either rights or promoter issue, I forget what it was. But essentially that concept became that Tata Motors is now the promoter of Tata Steel and Tata Steel is now the promoter of Tata Motors. That's how the Tatas have increased their own stake effectively because they control the companies through this cross-stake ownership. They've done this so many times that it took Chandra, when he came in, he said, look, what are we doing? Why is Tata Chemicals the owner of Tata something else, Consumer, and whatever became Tata Consumer eventually? And it was Tata Tea or Tata Global at the time. They both were promoters of each other. They made Tata Sons, which earns its money from TCS for the most part, paid both of these companies for the stake in the other company. And effectively, Tata Sons has now a greater stake in each of these companies. That's the way it should have been in the first place. But Tata Global got some money and Tata Chemicals got some money for their cross-ownership stake, which means the shareholders of Tata Chemicals and Tata Global benefited from, this. They should have done this right from the beginning, but they used shareholder money to effectively buy stakes so that they could retain control, right? And they've done this so many other times. They start a company, there's a company in the consumer space, and then they have some private set of companies in which they do another set of activities. So today there's a company that says Tata Neu. Who owns Tata Neu? You think that, it benefits from the Tata name and every of the Tata companies is giving a discount for having new points and all that stuff. So obviously this new thing should have some, be owned by some public Tata company. Answer, no, it's not owned by the public Tata company. And then you'll find out soon enough that there'll be a company going public which will own the Tata Neu thing. So in that sense, it is not shareholder friendly, where you're actually messing around with your public shareholding companies but creating private companies which have wealth for yourself. I don't like this phenomenon. I think it's bad behavior, but we love the Tatas and we will therefore, so at some level, we will penalize the Reliance and praise a Tata when the data actually shows it's the other way. And I'm saying this even for myself. It's not just you. I have a favorable view of the Tatas when it comes to that. But some part of my head says I don't think they're as shareholder friendly as they're made out to be. There are other examples. Today, recently at least, there was a situation where ICICI Securities, which is a company that owns a company called ICICI Direct, which is a broker. Now, ICICI Direct went public. ICICI Securities went public a few years back. It is 75% owned by ICICI Bank. And, the share price has not done anything meaningful since then. It's actually gone down quite a bit and then now it's come back a little bit. And what happened about last year was they announced that they would, merge it back into ICICI Bank and give the remaining 25% of owners shares in ICICI Bank itself. Now, you'd think that, okay, this is fine. And then how the shareholding ratio decided was, listen, at the time when this merger meeting was happening, there was a difference between the price of ICICI Securities and ICICI Bank. So for 100 shares, you'd get so many shares of ICICI. For 100 shares of ICICI Securities, you'd get so many shares of ICICI Bank. ICICI Bank traded a little bit more then, so it's a multiple, so it's a factor, say 1.6 or 1.7 times. So you'd say for 100 shares, you'd get 60 shares effectively because that was the ratio that was at the time. Now, at the time of this meeting, the ratio was favorable. So what happened was ICICI Securities ka price went up some 10 or 15% just to come to that ratio. Now, people said, this is unfair. Now, you're like, okay, what's unfair about it? You know what? When you sold us the company in the IPO, you told us it's worth 40 times earnings. Now you're buying it back, it's only 12 times earnings. Why is that? And it's a better company, it's a bigger company. Well, you know what? The company, when it was went for an IPO, was the biggest broker in India. And now it's the fourth or fifth biggest. Grow, Zerodha, Upstocks, and Angel One, all are greater than it. It does not have the same growth and ownership. It's actually losing a lot of customers because it's a relatively higher cost brokerage. It does not seem to be able to, get market share in any of the fields that's in. In fact, it loses market share in all of them, and it does not therefore appeal to the new audience and all that stuff. So there's so many things that can go against it as well. Where my view was, if the market thought it was more valuable, it would have valued it higher before this, merger thing. Since then, ICICI Bank is up some 40 or 45%. Now, we own ICICI Bank, so I'm very, biased here. Therefore, the price of the ICICI brokerage also has gone up 40-45%. It's not that, people have started to appreciate that stock more. It's just that the ratio means that since I know that I'm going to get that much of a ratio, but there are people fund managers and PMS managers, people who I respect. I think they've done a stellar job in trying to explain to other people that, listen, this is not a good ratio. It's fine, because now what has to happen is a vote has to happen for the remaining 25%, and ICICI Bank cannot vote. It's the remaining 25% have to vote for or against the merger. Two things happened. First, a bunch of fund managers went to a lot of people and said, please vote against this merger because it's not the right price. They should be paying a higher price. ICICI Bank, on the other hand, canvassed in its own way and went to the institutions and went to a bunch of people and said, listen, this is the right thing for you, because the company can't grow unless it's actually a fully owned entity and it's an unlisted entity, because then as a fully owned entity of the bank, it gets more flexibility. We can grow it and you'll get shares of ICICI Bank, which will anyway benefit because of it downstream. ICICI Bank would anyway benefit because ICICI Bank is at a PE of say 18 times earnings and you're buying something at like say 14, 15 times earnings. So every rupee of earnings that the market was earlier paying 15 rupees for, that market will pay 18 rupees for if you're simply part of ICICI Bank because it's merged now. This is better for the shareholders by the order of 5 or 10%. So it's not like a massive difference, but it's reasonably better. Now, I think here the thing evolved into when the share was lost, the vote was lost in favor of the merger. That means institutions voted for the merger, retail voted against the merger, but you take a combination, institutions effectively voted a lot more than the retail, therefore the merger was on. The feeling is that this is now something that the SEBI has to come and stop because it's something that's happening against retail shareholders. I think that is not fair. It was a vote. A vote has to be won by both sides. You can't complain that the vote is unfair after, the vote has been done. So if the process is that you require majority voting and the majority voting has been obtained, how can you say that this is unfair at some level? I think it's a little bit too much. So to canvass now a regulator and say, we are poor, silly retail shareholders, we don't know better. You sold us something at 40 times earnings. We bought it. Now you're buying it back from us 12 times earnings. That's a little unfair. At some level, we should be a little more responsible for what we know or earn, right? So, or spend on. So I think that is fair.
No, I hear you. So I think thanks for that. I think you rounded out the show with a bunch of anecdotes that reveal the world is always more complicated than you think it is. And I think if I were to sort of summarize the tenor of today's episode, the message we have is that, look, results are always a bit probabilistic. You don't know how things are going to happen. So be a little forgiving of outcomes, but don't be forgiving of intentions, which is kind of the opposite of how they talk about policy, right? They said, never judge a policy by its intentions, but its outcomes. I think over here, what you're saying is the intentions do matter as well. And so do pay attention to them.
In fact, I'd say the intentions are the things that matter. If you're going to penalize someone, penalize them for bad intentions, not so much for bad outcomes.
Well, interesting point of view. Well, thanks so much, Deepak. Well, folks, that's the episode. We had a bit more towards the end, but I think it belongs in a different episode altogether, so we decided to end it there. Come see our new website, which is live at capitalmind.in, and find more episodes of our podcast at capitalmind.in/podcast. Till next time.